Hi there, it's Jeff here with a policy in action video. Let's take a look at the key issue of the week, the threat and the introduction of tariffs from President Trump. So this is obviously the big news of the week, and it's likely to be one of the dominant stories as we head through 2025. Donald Trump, according to the FT here, threatening to ignite an era of trade wars with a series of new tariffs focusing initially on Canada, Mexico and China, but with the European Union also in his sights. And The Guardian hinting at a nice little bit of game theory here. Biggest US trading allies brace for a game of chicken with Trump's tariffs as Canada and Mexico draw plans to mitigate the effect of duties, potentially moving towards a retaliatory response. So Donald Trump has made a decision to impose pretty much immediately on assuming office, sweeping import tariffs from Canada, from Mexico and China, and of course that is sparking fears of a fresh trade war. So initially a 25% tariff on goods from Canada and Mexico, an additional 10% levy on imports from China, an escalation in Trump's long-standing trade agenda which goes back to his first term. Now let's be clear here, a tariff is a tax paid by US importers. A tariff is not paid, repeat, not paid by foreign governments. It's paid by businesses that import goods and services into a country. So when American businesses bring in goods, from cement to energy to component parts, semiconductor chips and so on, they must pay the tariff to the US government, and typically they pass on those costs to their consumers through higher prices. Now tariffs, they seem to be on their way on the US's neighbours, would mean that Trump is effectively ending the US-Mexico-Canada agreement, USMCA, on free trade that his administration negotiated and that he himself signed 2 years into his first term. Well, let's think a little bit about why, what are the motivations for the introduction of these Trump tariffs. I guess the first one is probably that the US trade deficit has reached astronomical proportions, and Trump views deficits as a loss for the United States, net outflow of currency. He believes, in relatively simple terms, I guess, that buying more from foreign countries than selling to them in value terms weakens the economy. Of course, that's by no means obviously the case, that the trade deficit is a sign inexorably of economic weakness, but that's something that seems to be part of their DNA. Tariffs are designed to provide a boost to domestic production, manufacturing and jobs. Traditional justification for tariffs, because tariffs make foreign goods more expensive, and that encourages a switch of spending from consumers to buy American-made products, potentially boosting GDP, manufacturing, output and investment and jobs. And of course there is wider strategic aims. Strategic trade policy suggests that tariffs can be used to level the playing field against countries like China, which on many occasions has been accused of unfair trade practices, artificially reducing the price of their exports, practicing import dumping, pricing below cost in foreign countries, the use of export subsidies, and the theft of IP. And there are wider, I suppose, we're moving away from the narrow economic justifications, particularly security concerns regarding critical infrastructure industries like semiconductors and steel, where the United States aims to cut their reliance on foreign supply and ensure domestic production capacity in times of economic crisis and disruption. What about the counter-arguments? What about some of the drawbacks and risks? Well, clearly there are many. The first and most obvious is that higher tariffs will feed through to higher prices. And again, let's be clear, high consumer prices are a direct effect, a direct impact of tariffs, because importers will pass on the additional costs onto their customers. It could be other businesses, or they could be final consumers, and higher prices reduces real purchasing power. Now, it could be the case, it's not automatic, that the US Federal Reserve could respond to this by keeping interest rates a little higher for longer than they might otherwise have been. The second big drawback has to be the risk of retaliation. So trade partners are not going to take this lying down. And of course, retaliatory tariffs or other forms of protectionism can hit American exporters, making US goods less competitive globally and potentially causing job losses. And linked with that is the fact that, often you import things to become an export. So there will be disruptions to supply chains that can increase variable costs. So a lot of US manufacturers rely on imported components. Their costs will go up, and that forces companies to either absorb the higher costs or relocate some production overseas, or cut jobs, or do all three. And ultimately, through causing higher inflation, through reducing the overall value of trade, it's likely to lead in the medium term to slower growth, because trade that is curtailed, or where the barriers to trade are erected, can lower efficiency and for sure increase uncertainty for many businesses, and perhaps deter some flows of foreign investment. Let's quickly recap, those of you doing economics exams, the tariff diagram. Let's take a market for steel where the world supply price in green is lower than the domestic price, for example, in the United States. So the US can import steel a little bit more cheaply of a particular grade of steel. Now, if you put a tariff on, then the world supply price goes up. And of course, the extent of the shift depends on how high is the tariff. As a result, domestic supply should expand from Q3 to Q5, but domestic demand contracts from Q2 to Q4. And therefore the volume of imports and the value of imports will decrease to the gap Q5 to Q4. So you can see how a tariff in theory can help to rebalance the trade account. And of course, critically, it also brings in some revenue. Now, again, we have to be slightly cautious here because Donald Trump doesn't quite seem to realise who pays the tax. This tax revenue would not come from foreign governments. It would not come from foreign companies, businesses trying to export to the States. The tax is paid by the importer and then paid to the US government. So that money would be it's paid by importers. It's not paid by the exporters. And we mentioned game theory. A quick word on the art of chicken. So the game of chicken is a classic game theory model. Two players are speeding towards a collision, and the one who swerves first is the loser in this game. If neither player gives in, obviously in theory, if you think about it, can face pretty severe consequences. So in this case, the US and its trading partners, in particular Canada, Mexico and China, are racing towards a potential trade war, a crash, each hoping the other will blink and concede first. Now, Trump's tariff threats and the implementation thereof are designed to pressure other countries into making trade concessions. But of course, if we get locked into retaliatory action, sort of backing down, the trade war can cause both parties to suffer economic harm. The optimal outcome, of course, would be involve negotiation and compromise so that this doesn't happen. So keep an eye on this issue. It's going to dominate the headlines for weeks, months, well, perhaps years ahead. Hopefully not. But it's clear that tariffs are now becoming, in many ways, a geopolitical weapon, particularly in the hands of a president who doesn't quite understand basic economics. Thanks for joining in. Take care, stay safe, stay curious, and see you sometime soon.